We now look at different examples of what you might expect to find in the exam. The first example is where an amendment is made to the plan which improves benefits for plan members. An increase in the obligation and expense is recognized. So when you make an improvement to the plan, it means to you, the entity, the expense will increase. Your entry will be to debit profit and loss and credit the present value of the defined benefit obligation. The next example is where an amendment is made. The next example is where an entity discontinues an operation so that employee services are terminated earlier than expected. This means that there is a reduction in the obligation. So this reduction is recognized at the same time as the termination benefits are recognized. Your entry will be to debit the present value of the defined benefit obligation and credit profit or loss. We now look at an example. Lewis Company, a PLC, has a defined benefit plan for its employees. The present value of the future benefit obligations at 1st January 2027 was 1,120 million, and the fair value of the planned asset was 1,014 million. So those were the opening balances at the beginning of the year of the benefit obligation and the planned assets respectively. You are given further data concerning the year ended as follows: current service costs, benefits paid to former employees, contribution paid to the plan. Then you are given the present value of the benefit obligation at the end of the year and the fair value of the planned asset at the end of the year. You're also given the interest rates. On 1st January, the plan was amended to provide additional benefits with effect from that date. The present value of the additional benefit at 1st January 2027 was calculated by actuaries at 40%, at 40 million. Required to prepare the required notes to the statement of P&L and other comprehensive income and statement of financial position for the year ended. We are to assume the contributions and benefits were paid on 31st December 2007. So you open your planned obligation. We discussed earlier that the current service costs, the past service costs, these are expenses which are recognized in the planned obligation. So, three items go to the P&L. The past service costs, the current service costs, and the net of the interest cost or interest income. The interest here, 58 minus 52, is based on the 5% times the opening balances, 1,120 times 5%, and 1,040 times 5%. you notice that the obligation is higher than the planned assets. Hence, the interest cost will be higher than the interest income. So the difference of 6 to make a total of 126, 76 plus 40 plus 6 to make a total of 122 will be debited in the P&L. In the other comprehensive income, where the items will not be reclassified to P&L, the remeasurement of the defined plan will be as follows. To get the actuarials like earlier discussed, we need to open the defined benefit obligation and the defined planned assets. So in the defined planned assets, we bring our opening balance of 1,120. We calculate the interest, which gives us 58. The 1,120 is the current service cost. The 40 is the past service cost. So the two give us a total, which we apply the interest to give us 58. Then we bring in our current service cost. Then we bring the past service costs. Then we take out the benefits paid. The benefits paid is the only entry which appears in both the defined benefit obligation and the defined planned asset. When we make the payment, it reduces our liability. It also reduces our investment in the planned asset. So you add 1,120 plus 58 plus 76 plus 40 minus 88. Your total, you subtract from the closing balance of 1,222 given earlier on. The difference is your remeasurement gain or loss, which will always be a balancing figure, or most of the questions you will have to find it as a balancing figure if you have not been given. We do the same thing for the planned asset. The opening balance 1040, the interest on the planned assets 1040 times 5% gives us 52. The contribution 94, and again the benefit paid, which is reducing our investment. We then add 1040 plus 52 plus 94 minus 88. The total, we net it off against the 1,132 to give us a balancing figure of 34, which is our revaluation gain or loss, again which goes to OCI. So in the statement of financial position, that is how we net off the statement of financial position. So the present value of the defined benefit obligation minus the fair value of the planned assets to give us a net. So you can see in 20x6 where the net liability of 90 increasing in 20x7 to in 20x6 of 80 increasing to 20x7 to 90. We now look at the settlement. Now These are various areas where you expect questions to come from in the exams. A settlement is a transaction that eliminates all further legal or constructive obligations for all or part of the benefits provided under a defined benefit plan. So this is a lump sum payment which can be made in exchange for rights to receive post-employment benefits. This could be in a situation, for example, where the entity decides to terminate the pension plan. It negotiates with the employees to be paid off a one lump sum against their future rights. The entries that you'll be required to do in such a situation is to determine the gain or loss on settlement, which will be recognized in profit and loss. So you debit the present value of the obligation as advised by the actuary, credit the fair value plan assets, any assets transferred, credit cash paid directly by the entity, debit or credit profit or loss depending on whether the entity has gained or the entity is losing out of the agreement. Finally, we look at the asset ceiling test. These are amounts recognized as a net pension asset in the statement of financial position which must not be stated at more than the recoverable amount. Consequently, IAS 19 requires any net pension assets to be measured at the lower of the net reported asset and the present value of any refunds or reductions or future contributions available from the pension plan. The amount is charged either to other comprehensive income. That brings us to the end of this standard, IAS 19. It is one standard which is highly tested, especially more that it was not tested at level 2 or F7. It comes in at P2. So review the video, listen to it over and over, find the question and attempt the question. Make sure you're comfortable with it as you go into the exam.